Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And this week, let's take a little glance at what the markets have done since our recording last Wednesday. Gold currently at $2,335. It's up about 1.5%, but actually down over the last couple days, peaking out at around $2,365. So big run up for gold over the last week. Moving over to silver, silver at $27.92, up about 2.7%, with a peak at around $28.73. So we did break above that $28 mark pretty strongly. Platinum broke 1,000, peaked out at 1,002, currently at $977, up 3.2% since last week. And palladium, 1,096 currently, but over 1,100, 1,128, up 3.3%. The S&P, taking a look at the broader index, the S&P currently at $5,161, down just under 1% from last week. And finally, the dollar, doing incredibly well, back up over 105, peaking right now. The dollar was actually down over the last week until earlier today, up about just under 1%, almost entirely today. So let's talk about why that might have happened.
Yeah, that's a huge dollar move. I mean, looking at this chart on the U.S. dollar index puts it into perspective. I mean, what a spike that is. And initially, gold didn't respond at all. In fact, gold kept climbing, all the way up. We saw it hit 2,358 despite that dollar rally. And it wasn't until it actually kind of stayed there a bit and you started getting more leaking out of the Fed that gold started to turn down. And to me, that really comes down to what's going to happen with the rate cuts. What is strong dollar policy?
I think that the chance went from 85% to a rate cut in June down to 15% today. So the market is reacting that the rate cuts are off the table. We've gone from what was projected to be 6 rate cuts for 2024 down to maybe 2 rate cuts for this year. So rate cuts look like they're increasingly off the table. The Fed is absolutely trapped. You've got the head of Bank of America begging for a 150 basis point rate cut, which means 1.5%. You've got Jamie Dimon over at JP Morgan saying, hey, I don't trust these numbers. I don't really trust this market. I think people need to stop drinking the Kool-Aid and start dealing with reality. He was trying to be as even-handed as he could, but he's very concerned. And the Fed really is trapped. They can't cut rates right now because inflation is so high. Inflation for the third month in a row keeps climbing, totally against what Chairman Powell was alluding to in his last address, that, we're on top of it, everything's okay. It's not okay. Now, in the meantime, with a higher inflation number, and Tori, you mentioned this earlier, with inflation today at 0.4% increase, that means somebody with $100,000 sitting in the bank just lost $400. So if the dollar's getting weaker, according to the inflation numbers, why is the dollar skyrocketing?
Yeah, relative strength. It's an expected policy. Everything tries to move through predictive fashion, but yeah, that's in 1 month. Just the March CPI came out with an increase of 0.4% again and 3.8% annualized, and they expected 3.7%, so underperformed again, or would you say inflation had a stronger number than was expected? And that's really not good. We know that life has gotten much more expensive, and the fact that there won't be a rate cut in June is really negative for real estate. That's a market that needs rates to come down. Volumes have slowed way down. That's just one market sector. Automotive, same thing. And so the games that the banks are having to play in order to get people to borrow to spend are getting more and more risky. And pretty soon the banks, you watch credit lines really tighten up here and housing really slow down. This is going to have a trickle effect. And Larry Summers is saying, look, if we were really being honest, this is Larry Summers. This is a very progressive economist, in the Obama administration. And he said that if measured accurately, the real CPI is 8%.
Yeah, because they take out food and energy.
Right. And the Taylor rule says that we should be at around 6.4% in our lending rate. And we're still 5.25%, and we're not high enough yet. So now if we do get a rate hike, Rob, and we not only get to reward the markets for the supposed 6 rate cuts that they were
Instead, we
pricing in.
punish them going a different direction. That's
Yes.
going to really rock the economy.
That's right.
Because the 10-year is over 10.5%.
Oh, let's look at that chart. Put
Yeah.
that chart up, Miles, because look at this spike. Just year to date, 70 basis points.
Which doesn't really relate to too many people, but it's an 18% increase in the yield on the 10-year Treasury, which your mortgage rates, your lending rates, everything hinges on the 10-year. And we've talked about that in the past.
And it's a measure of risk. For anybody that doesn't understand why that yield increase is important, what it means is the government has to pay more for people to fund them. Like there's greater risk in the market, so you're going to demand a higher return on your investment because the risk is greater, just like the banks do to us based on our credit reporting. And so that's really big. And look at what the bond sale did as a result. The 10-year auction today,
Oh, terrible.
cratered. Miles, that's an impressive chart. This is a D- score for the U.S. 10-year Treasury auction today.
Well,
Nobody is touching it.
If you go back 4 years ago, the yield on the 10-year Treasury was 0.5%. It's now over 4.5%. That is an enormous increase on the 10-year.
And talk about roiling the markets. And as that speaks to gold, I mean, Miles, as you go to put the gold chart up here, gold, obviously, major headwinds for gold are the Treasury yields and the U.S. dollar index,
Right.
as those really spike. Now, it's been climbing despite that. But we did get a little pullback here, Miles. I think we had a high of 23.59 today or so. And we got as low as, 2003.18 on that little dip back down. And now we're back to 23.33.
23.33,
Right in the middle there.
23.35, yeah, right around there.
Yeah, a good bit of reactive volatility in the gold chart today.
Yeah, and gold really is back and forth, but it's not panicking. Gold looks very solid here.
Well, and so does silver. I don't want to skip too quickly to it, but the gold to silver ratio over the last week has declined further down to 83-1 because silver is showing strong legs here. We got our 28 miles. I mean, you talked last week about that being a
Big
big
number.
point of resistance.
And, when we hit 90-1 beginning of March on the ratio, 90 ounces of silver to an ounce of gold, we told everybody the last 3 times it has done that, silver has climbed. And Tori, you've probably got the numbers there. But since we hit that number, that 90-1, we dropped down to 83-1 on the ratio today. That means silver increased 25%.
Yeah, and the low in the previous 3 times was a 37% subsequent
Right.
climb. And then we had a 74 and a 47%.
Yeah.
So 25% could apparently be just the beginning. And Miles, you talked again last week looking at the silver chart where you see silver potentially going over 30 and up to that 35 figure, right?
Yeah, I think that's still completely reasonable. One of the concerning things for anybody who follows the market, certainly on the short term, is how far can a run go? Like you always assume you're going to reach some type of barrier that at least impedes momentum for a period of time. But this is one of those interesting events. We're seeing news events, and I've said this before in the past, it's always fascinates me when a news event is the catalyst that pushes a technical pricing level into an expected range. Now, we've been talking about the 28 on silver because that gets you back into the top end area, going all the way back to like 2020, 2021, between about $28 and $30. And realistically, the reason I like 28 is because everything really above that was just intraday or interweek movement. That's where silver found its ceiling previously. It punched it pretty hard, but it wasn't able to break through. Well, now we're coming back into that, and the likelihood that you're going to have standing orders sitting there waiting to fill, I would argue, are relatively slim. So realistically, in a healthy market, you would expect this type of momentum going up should be calmed down, should have a little bit of a sell-off, or at least keep pace here for a little bit just to shake out some of the overbuying that's taking place. You look at RSI in silver, you look at RSI in gold, and the markets are way overbought at this point. However, continued news events and big announcements coming out of major banks like Bank of America and Schwab and TD Ameritrade and Fidelity. And when you start to get the leaders of these multi-billion to trillion-dollar companies stating that they have concerns when you see how they react on a day like today. Because you and I didn't get up this morning, wait for the CPI numbers, then liquidate our stock position and move into treasuries. The general public doesn't do that. It ain't us. It's big money that's pushing those yields up because they're looking to scrape tens of thousands to millions of dollars off the top on multi-billion-dollar positions by capturing that extra fraction of a percent. The average person doesn't do that. So it's not the average person pushing these markets.
And the money is coming out of the longer term treasuries and into 1 year and shorter treasuries. That's where the yields are dropping.
Oh,
the
yeah.
yields on the 5-year, 10-year, and 30-year.
They're all stacked. But
Yeah.
they're all stacked about a point below the 1 year. You know, the 1 year's yield is 5.2. The 2, 5, and 10 are all between like 4.5 and 4.6.
Yeah.
Yeah.
So they're coming out of their longer term bond position and going into shorter term treasuries.
Well, and that's
the
what
bond market got crushed today.
Crushed. And isn't that what the average person would be doing? Not sitting in cash in the bank, but seeking the highest yield in a short-term window.
And it was not a
Whether
good
it's a
day
CD,
for them.
no, not a good day for them, but even CDs.
Yeah.
The 3 to 6 to 9 month deal where you're in a short-term lockup, but better than sitting in cash. And again, losing your $400 just in the month of March on $100,000 sitting in the bank. And yeah, I mean, I would be doing the same thing, that or gold. I mean, looking at the performance of gold, it's the true hedge on your currency and remains so. Silver has a lot of catching up to do. We're excited about the initiation and the furthering of the trend. I hope that this is the beginning of this ratio coming down into the 50s.
That would be amazing.
It would be amazing, and it'll get really exciting, and it will equate to more gold ounces. And by acquiring silver here, it's like getting gold at $1,800 an ounce, potentially, if that ratio keeps going. If you feel like you've missed the gold price, buy silver here and swap it into gold later, and you'll see that it will equate to you saving $400 to $500 an ounce on gold.
Without too much effort. I mean, a 50-to-1 ratio is not swinging for the fences. You know, that's a modest expectation. I mean, you have people out there claiming it's going to get to 30-to-1. I'd be thrilled if we got to 40-to-1.
Yeah. Well, again, it's all going to come down to these rate cuts, and with other central banks talking about cutting rates and not necessarily being in an election year. Bill King put it the best. He said a higher than expected March CPI report will kill the chance of a June rate cut and probably a July rate cut.
Yeah.
More importantly, the window for a rate cut at all in 2024 could slam shut because it's too close to an election and would be perceived as election interference. And so you may be saying bye-bye to any rate cut and looking at what Larry Summers was mentioning, and that is potentially a hawkish rate hike in 2024 in order to cool what's really going on here inflation-wise. People are feeling it. And Rob, you said it. Taking out the food and the fuel that are skyrocketing is criminal because oil's up 22% year to date just in 2024.
Just this year.
Right? And strip that out all you want. That's where you're really at that 8% level that Summers has also described.
And they don't see that as affecting the price of food, but it does. Because, you know, farmers rely on fuel for their fertilizer and their equipment. So that's factored into the price of food on top of what's already happening in processed food world anyway.
And transport of the food.
And
You've
transport.
got to take that food and deliver it to the grocery stores.
Good point.
Rate cuts aren't going to happen until the average person thinks they'll never happen again. Let's look at human psychology here. I mean, according to the average person, when was the absolute best time to buy a house ever? 2006? Right before the housing market crashed. When was the best time to buy stocks ever? 2008, 2007. It's natural human psychology, right? Yeah. We're still getting our Fed announcements. They're still sitting in the room asking for the punch bowl back. Eventually, the human psychology is going to change from, can we please have a rate cut, to maybe he really is going to keep raising rates, to eventually we're definitely in a rate-raising environment that's years down the road, to I bet rates are never going to go down again in my lifetime. And that's when I'll start looking for a rate cut. But in the meantime, interest rate cycles, and we've talked about this around the office for years, interest rate cycles are decades.
Mm-hmm. Decades.
Yeah,
Yep.
you don't just pop interest rates up for 2 or 3 years. It's 20 or 30.
And the only thing that interrupts it is major crisis.
Yeah.
And so if we're not in higher rates for longer, it's because we're in some really deep, bad waters economically and fiscally. And gold is kind of telling that story that despite, again, the treasury yields and the dollar strength, it keeps climbing. And Miles, if you will, let's put up the gold and silver chart one more time with the moving averages, because it shows you how aggressive this move is too, with where these moving averages have gone, despite that headwind in those other areas.
Stronger dollar, rising yields. Gold is taking that in stride
Yep.
and keeps moving forward. And we may have a couple of steps back, but I think the biggest question in the minds of our clients, are we on the verge of a breakout? We are on the edge right now. We could and should technically see a reversal and some profit taking back down to 2,200 or maybe even as far as 2,100. With world events, Iran is moving ballistic missiles. They're going to retaliate against Israel. I mean, you have fundamental events like that. You have a weaker dollar in spite of the fact that the dollar jumped today. But that's because people are selling out of their stock and bond positions, going to cash for the short term until they decide where they want to go. We have commitment of traders, which are long both gold and silver. You know, the hot money is long. What are they going to do? I don't know. But the biggest question in the minds of my clients is, are we on a breakout? I want to say yes, but I don't know yet.
The thing about breakouts too, Rob, is when they happen, they don't happen under normal trading conditions where you have the rises and the falls. And you don't have to go far back. You just look back in 2019 when we broke out above that 2014 to 2018 trading range between like 12 and 1400. When we made that breakout, we took about a 13 to 15% jump up in gold, and it didn't come back down. In fact, it went up another 10% on top of that. You can look at the same time frame back in 2009 when gold took the move above 1,030, you know, that previous all-time high. You're talking about gold jumping up 30% in a very short period of time into 2010. And did it come back down? No, it went all the way up to 1,900. It more than doubled. So the interesting thing about these major market breakouts is once you bust through the line, no matter what the technical indicators tell you, momentum takes over. And if you add momentum to political, economic, financial, or geopolitical unrest at the same time, Katie barred the door.
That's gasoline to the match, yeah.
That's right. That's why a 65% move in the gold price up to $4,000 gold is completely reasonable.
Yeah.
And so that's really, when you're talking about breakout, that's when we'll look back and say, Rob, you were right. That was the breakout.
But, you know, we invest our own personal money, but we're responsible for so many people's life savings. You just don't want to sit there and pound the drum and say the ship is leaving the station, but what if it is?
What if it is?
That's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell, and head on over to our website at McIlvaney.com. You can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. And finally, if you'd like to speak with one of us about your personal investment or precious metals portfolio, give us a call. We can be reached at 800-525-9556. Thanks for listening and have a great week.